Okay, this is a very quick video, and it's aimed at the trading group. And essentially, what I will do is I will record a video for anybody in the group that is having issues, and I'll delve down into those issues. This is a quick video with regards to helping some of the people in the group in terms of identifying targets. And, be of no doubt, we've got some really talented people in the group that are able to trade. And this is one thing that people have mentioned that, I've identified as a potential issue that may make them even better traders. And so I want to get that knowledge out there, because the better traders we've got in the group, the better everyone else is going to be. We're going to have more people able to, jump in and answer questions. I think one of the principles of trading is getting ahead of the market. One of the questions I'm always asking myself with markets is what's missing. And I think I'll share a chart, and we'll start to delve down into some of that. There's a principle, if I was running a trading group, I would call it the Art of War trading group, in that markets, you'll never see two charts that are exactly the same, but what you will see are the same things repeating on charts over and over again. And if you can get ahead of the chart, if the chart is your enemy, the price manipulations that are taking place on those charts are your enemy. If you know the types of things that they will do, if you know where they're extending to, then you can get ahead of the market, and you can start asking yourself, what's next? If you can answer the question, what's coming next, then that puts you ahead of the majority of traders out there are just reacting to what's happening in the markets. So without more ado, what I'm going to do is I'm going to share my screen. So just give me a second, and I'm going to share my screen. And I'm going to share my MetaTrader screen, and I'm going to go there. Now, this is a blank chart of gold, and it is literally the first chart you get when you load up a gold chart. What I'm going to do is I'm going to add my standard template to it. So I'm going to add a template, which is my cap standard with stochastic and MACD. If you're new to trading, this may be slightly complex for you. So I'd like you to go back to the beginning. If you're not understanding the concepts that are here, then let's get you back to the beginning and get you back to easier subjects. I'm going to take off one-click trading. I'm going to right-click in MetaTrader, and I'm going to go to properties. And what I'm also going to do is I'm going to put in the period separators, and I'm going to go OK to the period separators. Now, between the period separators, what we have is 1 week's worth of trading. So this was literally on the 4-hour chart. We have 4 hours. We have each candle represents 4 hours worth of trading. So what I'm going to do on the chart as well, won't get this to. What I'm going to do on the chart is I'm going to zoom out. I'm going to minus this chart a little bit, and you can see what's going on is we've got last week's trading here, week before, week before, week before, week before, between these white lines. I wanted to respond to Samuel in the group with regards to use of Fibonacci. And I think use of Fibonacci is definitely one of those tools that enables you to get ahead of the market. And unfortunately, there are a lot of things that are omitted from a Fibonacci tool as standard. What I do is I use my Fibonacci not only for retracements, I should say, retracements in the market. I also use the same retracement tool as to predict extensions in the market. And if I click on my Fibonacci tool, it's very important with Fibonacci to go from the swing low to the swing high. And if you get the initial swing low and swing high right, then that gives you some predictive qualities as to where the market might be headed. So what I've done is, if you look at way back in October, the market manipulated down and then headed upwards, breaking out of a box, breaking out that channel, signaling the end of the downtrend. And I think where I posted this chart before, there is an 800 daily exponential moving average down there, which is a good exponential moving average for the end of trends. What has this chart effectively done? It's printed a W at the bottom and price has taken on from there. What you can see is that price has taken off very rapidly and has barely retraced at all. It's barely come back 23.6% in terms of retracement. Now, that's not unusual. That's really that's something that you see in extended trends. So what I've also done with my chart is not only have I got retracements, but I've also added in extensions on the chart. So I've got a 1618.8 extension. I've got a 261.8 extension. I've got a 300 extension. And you can see there's resistance up there. Price stalled at this 300 extension, which is what you kind of expect. You'd expect to pause there and price to pause there and to keep going. What we've also got is we've got a 423.6 and a 461.8. These are all multiples of Fibonacci numbers. Now, if you got into that and you know that this market is taking off and you got into a buy, you got in, let's say at this area, you got in at the W there, where would you want to trade it to? The 300 extension with with associated resistance there would be a good place to get to. So if you take away everything to the left of this, to the right of this chart, and if we started, let's say here, and we've already got that swing low to swing high, then we can get into the prediction game. We can get into, you know what, that 300 might be a good place to get out of this trade. As this is a fairly extended trend, 4618, we also got resistance there. So as soon as we broke that, 4618 could be a good place to go. We're breaking beyond the 4618, and by my reckoning, if I squeeze this chart down, we've also got a 685.4 extension, which is, I think, our next destination. I think the market will come back. As things stand this week, we are waiting on a, this is the time of this recording is at 12:26. So in an hour's time, we have a US data announcement. I think it's consumer price inflation or something of the ilk, red letter news on Forex Factory. If the news is bad for the dollar, then there is a potential for price to wind up at the 685. Now, in my YouTube channel, I have a video as to how you can add in these extension levels to your Fibonacci tool. The most important tool is to get the swing high and the swing low. You won't always get a clean shot at that, but and by that I mean it won't always look obvious, especially in this case of gold with an extended market. But what is happening is we've swung low. We've manipulated out of that area. We've taken out stops that would have been down there. That's a liquidity grab. And then we've swung low, and then we swung high. And literally, the Fibonacci retracement tool is run from the swing low to the swing high, the first swing high. And that in turn will give you these extensions as to where you can expect price to start stalling out. You can also, if we look at the 4618, price is effectively reversed from there. So we've produced an M there. So we can start to get ahead of the markets and start saying, well, look, this is fairly extended now. If we look for an M and we get an M here, then this might be a good place to go short in order to trade down to, this is the 800 exponential moving average on the 4-hour chart. And we can see that that drive stopped at the 800 exponential moving average. The other thing that you're able to do is if I take another Fibonacci tool, you can trade from the swing low, swing high, I should say, sorry, to the swing low. And I think it's important to do it on, it's important to do it on the swing high. So you've got to make sure that where your Fibonacci starts from to the swing low, and then you get a retracement. That's a fairly healthy retracement. What we're getting is an ending again at the 4234618. So we can use this Fibonacci's in both directions. When I spoke to Dritan always used to ask me, why are there why are there multiple Fibonacci's on my chart? Well, what I'm trying to do is when I see it swinging low, I want to know where that's likely to end. And we can see that it's ended at the 4618. Again, we produce another W at the bottom, and then we can start swinging high. Again, I can use my Fibonacci here. I can start from the swing low to the swing high. And if I come down to a shorter time frame, so I'm going to do that on the 1 hour. So I'm starting from the swing low there to the swing high. Again, price is not retracing a whole load. So I'll move that up there. But we're at the 200. Now, I've got some details regarding the course that I spoke that gives you some explanations into what happens at each of these levels. So on the hour chart, we've come up. Again, we've not retraced much beyond 23%. We wound up at the 200. A good ending point, if we have a look to the left of the chart, we've got resistance there. Good ending point is 300. So if you're a buyer in this market, I think you'd be safe to buy this up to 300. We've got the announcement coming through. So over the next hour, inside the next hour, we will work out where these Fibonacci's go, where price actually goes to. Price might manipulate down here first, but we've got the 50 EMA crossing the 200 EMA. That's about to happen. And so the next thing we'll look at is price coming up there and maybe a bounce down into the 50 and 200 meter EMA before you take it higher. The advantage, as I say, of using these Fibonacci's is that you get the ability to be able to start to predict, get ahead of the market, understand what it's likely to do next, rather than trading what you see. And I know, people like Dritan, you are scalp traders, so you will trade what you see. As soon as you get an indication in the other direction, you will get out of that market. Well, this is another way to predict where to get out of a market. As I say, there is resistance there. So trading from that swing high, that swing low, we've taken out that. So yes, we are likely to go higher. That was the last point that's where price was sent lower. So once price is sent lower and we break above it, we're effectively in an uptrend. What are the targets for this uptrend? Well, we've definitely got one at 300. And there's another one if we break above that at 468. If we go back to the 4-hour chart, we can see that the 685 on the larger time frame is lining up with that. You can also see that the 685 on this chart is lining up. On this swing, on this Fibonacci is lining up there. And just to put a price on that, that is $2,064. And the 685.4 here is lining up at 2,054. Now, there's a very useful book written by a lady called Caroline Bowden, Fibonacci trading, for professionals, and it details some of these techniques as to where you can start predicting where things are likely to end. But if you've got two Fibonacci's lining up, saying this is where they're likely to wind up, then you know that trading price up to there is a good price. It might be a good thing to do if we get the right indications with the news later today. And we also know that the 685 is highly extended. So that is a great place to look for price to reverse from once it reaches there. Yeah. So we're not reacting. We're in the game of understanding what markets are likely to do. Now you can say, I've done this specifically with gold. What you can specifically do is take any instrument, and these retracements and extensions will play out. What I've also got, if I stop sharing the screen, and if I go back to here, and I'm going to share something. I'm going to share my. I'm going to share some additions that I'm going to put into as accompaniments to this video. I'm going to share those with you now. What I've also got is some Google. I've got some Google slides where I taught this in the during lockdown, and I taught this to the 100 Black Men of London. There's some details and a link to Caroline Bowden's book regarding Fibonacci trading, which goes into a lot more detail. You might be able to find a free PDF copy online, and I'd urge you to do that. It's quite an expensive book going back to 2008. What I also did as part of that course was I did a detailed introduction to Fibonacci. So if you're new to Fibonacci, have a look at these slides. It will give you an understanding of the ratios. What I also do is in these slides, talk about it. It's what I call God's numbers in the markets. I do a breakdown of each of the retracement levels. So 61.182, that's normally considered the retail traders retracement level. The 76.1, 78.6, that's where professionals look for retracements, and it's a common retracement level in Forex. If I go back to my gold chart, I can also give you some details as to where we expect that to retrace as well. But if I was looking for a retracement on gold, I'd be looking at the 78.6% retracement. It's a common retracement. 50 is where a lot of people have been taught to look for retracements. It guarantees that you get it, that you stand a better chance of getting in. However, as you saw with the gold trade, it took off from 23%. So it's not always at 50% that you will get in. 88.6 is a really deep retracement. So I go into details of all of these retracements. And what I will do, that's a 23.6 retracement that you saw in the gold video. So I go into details with regards to all of these, and I also start to go into details with the extension, with the retracements as well. And there's also retracements that people don't look for. These are negative retracements where you can start looking for reversals as well. So you can have a retracement that comes back beyond 100%. And I've put details with regards to those. Also in the book, sorry, not in the book, in the YouTube directory, is a video, short 15-minute video that shows you how to add these retracements and extension levels to MetaTrader. I know a lot of young people, I know you, Samuel, you use TradingView. It's possible, and if you give it a Google, you can definitely add extensions and retracements, different levels to TradingView as well. So there's something for everybody. Unfortunately, the people that provide the tools for trading, they want you to trade. They don't want you necessarily to be trading in the right way and providing you the right levels at which to look for things and extension levels at which to look for things. Because if they provide all of that and they teach you all of that, then it restricts the amount you will trade. You'll tend not to sell at 200% because you'll be looking for an ending at the 2618 or the 300% or the 423%, etc. So it's getting, as I say, ahead of the market, and it's a detailed view of getting ahead of the market. It's Sun Tzu, Art of War. If you know what something's likely to do or what something is intending to do, then you can head it off, or you can join in, you can be part of it, yeah, rather than reacting. And so I hope that this has proved useful. There's the information on the extensions. There's the 138 extension, which is typically where things tend to pause. There's a 1618 extension, which is a good place to get out. The 127 is a good place to get out as well. You don't always get the 2618 or the 300, but a 127 is often guaranteed. You've got a 300% that I've spoken about and I've showed you on the gold trade. You've also got the 200. Things tend to get a bit choppy around the 200, so you might get whipped around at the 200% extension. The 4618, as I say, is a good place. 423, 4618 are good places to get out. And what you're able to do, you've seen the techniques that I've used, you're able to cluster these Fibonacci's, see where things are likely to retrace to. If you've got an extension and a retracement that overlap, an extension going down and a retracement from the swing low to the swing high, then you can predict a good place to enter trades. So it's not a lot of the Fibonacci stuff overlaps with Elliott wave, So if you've got a good appreciation of Elliott wave, then you should be able to understand what's happening and where to run these swing highs and swing lows from. But the most important one is from where the drive starts. The swing high, the swing low to the swing high. And if you and a buy in a market that's bullish, and the swing high to the swing low in a bearish market. And I think that's probably about as much as I want to say. And yeah, I think I'm going to leave this video at that for now. If you've got any comments, come back to me. If you need anything explained, then please come back to me as well. I'd be happy to ask. And if I need to do another video, then I will do another video breaking this down as well.